to illuminate us on how you can win with investors is Luke Vernon, who's the managing partner at Ridgeline Ventures. Thanks so much, Luke.
Thank you, Carol. All right. I don't know about illuminate, but I will do my best. I'm actually pumped to be talking with you about this topic. It's something I'm deeply passionate about. And it's because I know how absolutely grueling it can be to raise money. I've had the experience of raising angel capital and venture capital myself as an operator. I ran a company for 9 years that we grew to 80 million, and it was acquired. But I also failed at raising capital, and it can be a lonely time trying to raise capital. You feel like the weight of the world is on your shoulders. But I took those emotions and those feelings as inspiration to become a student of the fundraising process. And having seen hundreds of investment opportunities every year over the past few years, I've really tried to connect the dots of what makes a successful fundraise occur. So that's what I want to do today. I don't want to help you just become a little bit better at raising money. I want to help you absolutely crush it. Does that sound good? How many people in here are raising money or plan to be raising money in the next 12 months or so? All right, good. So I'd be remiss if I didn't just mention who Ridgeline Ventures is. We're Boulder-based along with some other terrific investors. We are a group of 4, and what's most unique about us is that we don't have any outside investors. So by the function of investing our own capital, we believe it offers us an opportunity to really think long-term with founders and entrepreneurs. And it also gives us the flexibility, some really unique flexibility on the size and stage of companies that we invest in. So generally speaking, our initial check is 1 to 4 million, although we've written checks as large as 9 million and as small as 250,000. And the sweet spot for us in terms of investing is companies that are in the 5 to 20 million revenue range, but we have also invested in a company that was just below 1 million, and we've looked at opportunities larger than that as well. We're going to start by talking about just a couple of metrics to give a little foundation for how investors are graded, what goes on our report card. And the 2 metrics that are really most important are cash-on-cash return, pretty straightforward. You invest $1 million, you get 3 million back, you get a 3x cash-on-cash return, and internal rate of return, which, as you all know, is the annualized rate of return over the time period that you're invested. So let's put ourselves in the shoes of venture investors. I want you to, however painful or perhaps glorious that may be, think of yourself as a venture investor right now, and also pretend that we all have a crystal ball, because all investors do have a crystal ball. And you have 1 of 2 options. You can either take a 2x investment in 3 years, or you can take a 3x investment in 7 years. How many of you would take the first option? Raise your hand. How many of you would take the second option? So the interesting thing about this is that it's not as black and white as a lot of people may actually think, because the IRR is actually lower on longer term investments, generally speaking. So the longer you hold a company, the higher your return, the higher your cash-on-cash return needs to be to generate that higher IRR percentage. But what does this really have to do with you and how venture investors think? So in order for a venture investor to continue in the job that we're doing, we have typically venture investors have a 10-year fund life. And so we have to raise another fund within that 10 years or we're out of a job. And what's kind of deemed as a respectable venture return is 20% IRR over the life of that fund, and that's net of fees. We collect fees, most venture firms, they collect fees from their investors. And that generally equates to a 4x return on every investment that we make, which is assuming a 5 to 7 year hold period. So some investments may have a lower return on a shorter period of time, and some we may have to get 6 to 10x cash-on-cash return to get 4x over the life of the fund. So what this means for you as an entrepreneur is that in terms of how we're framing our decision-making process is that we have to pick companies that we think are going to be an unambiguous winner in their category. And it doesn't have to be the only winner in the category, but we have to believe it's an unambiguous, it's one of the very few winners that actually do get acquired. And so that's why it's so important as a founder for your job to help us paint the picture of what your story is. Paint the picture of your company, because if you let us paint our own picture of your company, it'll likely end up like a preschool art project. And I have 3 young kids, so I do say that with fondness. But the reality is that we get into the nitty-gritty and we paint our own pictures, and if it's not how you're envisioning your company going, then the likelihood of a fundraise is lower. So that starts really with 3 kind of quick questions that we ask ourselves. Number 1, is it a good product, good brand in a big market that's accepting of it? And I emphasize the big market here because, again, we have to believe that there can be multiple winners in a given category. Second, are they building the right team to be able to execute? And that has everything to do with, do we want to work with that team? Can they attract and retain the right people? Not just internally, but also as advisors. We look for what advisors they've surrounded themselves with as a signal for the quality of entrepreneurs and the quality of the idea. And lastly, can they do what they say they're going to do? And that all comes down to execution and existing traction. From there that's the point in which we really dive in, and that's the point in which we really look for you to pick up your brush and paint that Mona Lisa around a whole bunch of different areas and data points. But just to highlight a few, consumption potential and occasions. Is the product that we're looking at, is it one that's consumed multiple times a day or multiple times a week, or is it one that's consumed once a month? Generally speaking, strategic acquirers pay more for businesses that have a more frequent use case in front of consumers. And so investors tend to bias themselves that way too. So what's the story around the product portfolio that you're developing, and are there opportunities to bring more frequent consumption into it? Next is velocity, really on and off promo. And what we're looking for here is really what's the strength of the tribe that you're building when the product is not on sale. So is there a sustained lift after the promo has ended? Regarding your innovation plan, we've found in our experience that entrepreneurs tend to overweight innovation as they're raising money. And while we like to see the ideas that are in the pipeline, the reality is that there's no better way to tell a story than data points. And so we really value the existing product portfolio, look to the new ideas as kind of nice upside, but really can't value that into the valuation process as heavily. Gross margins, most investors look for margins that are 30% or more, or at least trending there net of trade spend. And so we want to understand what your gross margin story is, where it's been, why, and how you're going to north of 30. And then lastly, again, what I'll mention is really attracting and retaining talent. And I think any investor you ask will say that the people are the leading indicator of success of a company. And so we spend a lot of time really diving into not just who your team is today, but what does the bench of candidates look like? What are the roles that you think you're going to be able to fill, and who are you going to be able to fill those with? So quickly, I'll run through 10 tips that I've gathered over the years in preparing for a successful fundraise, and it really all comes down to preparation, breeding success. But it starts with your books, and it's we've come across we've seen a lot of businesses where, and it's very common where kind of finances can be the last thought, or at least the least enjoyed part of an entrepreneur's job, and so they often get pushed aside. The reality is that all reflects on the quality of the business, quality of operations, quality of the founder in our experience. And so really making sure you have the proper chart of accounts, that you have gross margin and trade spend accounted for properly, and the financial model is really sound. In addition is, what does your syndicated data look like? Are you buying syndicated data today? If not, then is there an opportunity to access that where you can tell the story over the long run and where the opportunities are to grow? Regarding intellectual property, this spans everything we all know is intellectual property with trademarks, but we were also involved in a fundraise in which during diligence we uncovered that the primary co-packer for a business had an agreement in place that the co-packer actually owned the formulations. And so those agreements can take weeks, if not months, to renegotiate. And time and having delay a fundraise can kill deals. And so making sure that those details are buttoned up ahead of time is quite important. And we've talked about the team quite a bit, but making sure that there's a plan in place once funded, how you're going to fill those, and is it believable? Investors like to fund businesses that are at an inflection point ready to scale, and we like to fund growth drivers being marketing and sales, and we're less inclined to fund paying off debt, to liquidate founders. And so what is the real specific game plan around that use of capital? On number 7, building relationships with investors. It's interesting being kind of looking back at the experience I had operating and now today as an investor, and we tend to gravitate towards people that we have relationships with over a period of time. And I think if you look at the funding announcements that occur and you dive deeper into who's funding those, that there's usually relationships between the entrepreneurs and the funds or the firms for a period of time before, not just the 30, 60 days before the fundraise, but several months before. And so those relationships take time, but incredibly valuable, and at least a touch point via email or phone or in person goes a long way. And one way to do that is by talking with CEOs who have recently raised. And if they have a good group of investors, then oftentimes they're willing to provide introductions. And the referrals are the name of the game. And before you fundraise at all is really preparing that data room. So do you have all your company legal docs, financials, syndicated data, marketing presentations, everything buttoned up in a folder, Dropbox folder, or another place where you can turn that on and provide it to investors right away instead of delaying a fundraise process? And we've seen fundraises usually take 6 to 9 months, so plan ahead and make sure you have enough capital to get you there. I want to walk through a quick case study. And this is a company that we were involved in, or we are involved in, and this founder just architected the fundraise process beautifully in my mind. And so I want to walk through that, as I think there might be some opportunities to kind of see what he did and learn from him. And the most important in my mind, and if there's one thing that you walk away from today, it's that I hope that I've stressed enough that thinking ahead of time of what the story is that you want to tell when you're going through the fundraise is really the most important part of it. So planning ahead for when you're going through the fundraise, what exactly is the story around velocity and where you are in that growth period? And how can you manufacture investor interest? And that's exactly what this founder did. So we met with him for the first time Q2 of 2016, and in that meeting, he suggested that he was targeting a raise roughly a year later. So we knew we had an opportunity to kind of get to know the business, and one way that he allowed us to do that was providing monthly email updates. And immediately after that meeting, started sending us these updates, and those were anything from how they were beating projections, their strong momentum, press clippings, adding new team members, even to the extent of some lowlights and some learnings that they were gaining as they were growing through the year. That built our excitement, and we had another meeting with them in Q3, and sure enough, immediately following that, the founder indicated that he wanted to move up the fundraise. And from an investor mindset, when we hear move up a fundraise, it's either, well, the company hasn't spent money well and they're running out of cash, or they want to put some fuel on the fire and really accelerate growth because they're at an inflection point. And that's what the case was here with this business, citing really wanting to fuel the fire. the same time really seeing that there was strong investor interest, and that scarcity factor, knowing that there's other parties in the mix, creates that fear for investors of wanting to kind of dig in. This founder also had a data room already available or immediately available when he said that, even though he said that initially he would be raising money the following year. So he had planned well in advance, have all this information prepared and ready to be turned on as soon as he needed. And he was smart enough to know that he would be hitting his peak season in Q4, and that's exactly when he wanted to have peak investor interest. So sales were growing rapidly month over month. Syndicated data looked fabulous. He was generating buzz and PR around new product launches. And so he knew that well ahead of time rather than raising during a slow season, even though it certainly is a time constraint. And we continued to receive more frequent email updates. And he used terms like, this will likely be an oversubscribed round. And that's the fear of missing out that investors start to get around, well, we really need to button down here. And the existing investors were very engaged in the process, which is a strong signal of their feeling about the business. And sure enough, multiple term sheets were submitted, and the round was closed in January. And so if you look at the time of the actual fundraise, it was really only a few months. But this was a year in the making in which he knew exactly the story he wanted to tell and when. And it was a very successful raise for them. So I will kind of wrap up with a few closing thoughts. And one is that really my belief that there are three categories of investors. One is that they say, the investor that says yes or no quickly, and certainly a quick yes is the best answer, but a quick no is often the next best answer. Second is the maybes, those that ask a lot of questions and maybe just take a little bit longer to get there. But they also look for additional proof points before they jump in. That could be a lead investor, or it could just be wanting to get to know the entrepreneurs. And those maybes are often strong prospects, but they can also bleed over into the time thieves. And that's the third category, being oftentimes a little bit less experienced of investors, those who aren't quite sure on their thesis around investing. And the way to uncover those time thieves, and from what I've really seen, is asking about what is their decision-making process. And most important of all is talking with founders of companies that they've already invested in and understanding what the process was like for them. And then the last thought or idea is really around valuation and being cautious not to over-optimize on valuation. What I mean by that is just keeping the important things important, which are choosing the right partner and closing a deal. And when you think back on the returns that investors need to get on their funds, that we have to believe that whatever valuation we're investing in now, that there really is a clear path to get at least 4x return on that business. So modeling that out yourself, you can kind of see, does that make sense or does it not? And I've yet to see a company go out of business because of a few extra points of dilution, but I think we've all seen companies go out of business that weren't able to raise the capital that they needed in the time that they needed. So that's all, a few minutes early, and if I can be helpful in any way, feel free to reach out. Luke at ridgelinevc.com. Thanks.
I think we have time for a couple of questions if anyone has.
Yes.
Well, can you just talk a little bit more about how to distinguish between the maybes and the time thieves? The similarities between them are very, very close, and it can be very difficult to distinguish. How can you advise on that?
Yeah, the question was around distinguishing between the maybes and the time thieves. And I guess, and that was probably one of the most frustrating things as I was on the kind of operator side raising money, is the people that just drag their feet. There were two things that investors did that just bugged the hell out of me. One was that they wouldn't give you an answer on why they passed. And the second is they just dragged their feet. And you're like, come on. And I guess, so I like have an oath to entrepreneurs that I'm gonna not do that. I just believe that you just gotta be straightforward. But I think the way to distinguish is by asking some of those questions, really drilling into who are the decision makers in your firm, asking questions like, are there any concerns that you see at this point in, in looking at our business? And really trying to drill into that to see if those are kind of artificial concerns or if they really believe deeply in that. And then look at their portfolio and talk to their founders. I mean, going back to what I said, I mean, that's really the best way to understand how they work. And so otherwise it's, you're just kind of going off of a whim of if they're gonna, how they actually act in real time. And sometimes those are the types of, kind of, if they haven't experienced, then what they'll do is just kind of drag their feet and put, they'll do that by design to get egregious terms in front of you as you're running out of options. So I think it's try to get those references as quickly as possible and ask other entrepreneurs. So, and ask what other businesses they've looked at if they're willing to share that, because those are data points. So,
All right, let's take.
Yeah.
Do you have a minimum number of SKUs that you're looking for when you're looking at a company to invest in, or maximum? Would you invest in one SKU?
Better be a damn good SKU.
WD-40.
Yes.
All right, I think there was, we have time for one last one.
Luke, quick question. You mentioned investing at inflection points, right? And really using that capital around sales and marketing. Can you share, already having that capital, what some best practices, perhaps your portfolio companies can have scaling up that inflection point fast for those funds?
So I'm sorry, just to be clear. So how to are you talking after raise? After raise, hitting that inflection point?
Yeah, you got the money in the bank.
Yeah.
You know you're at that inflection point. What have you seen as those best practices with those funds?
Yeah.
Really.
Yeah. Yeah, well, I guess our experience, it's kind of situation by situation depending on the the market and where the product fits, and but really all coming back to sales and marketing spend and how to build that loyal tribe following, and is the goal around new distribution points, or is it around driving velocity at that given time? So deploying against kind of area sales teams, people out there on the streets, deploying against digital marketing, whether it's e-commerce related activities or it's geolocation, deploying against sampling, being a big part of that as well, and just trying to drive trial, shippers, some of those things to get product in front of customers.